Everyone, my name is Gigi LeKites and I'm a financial advisor with PKS Investment Advisors. We are affiliated with PKS and Company, the tax accounting firm. With that collaborative relationship, it allows us to say what we like to say, offer all things financial under one roof when we have three locations: Salisbury in West Ocean City, Maryland, and Lewis, Delaware. Today, we're going to be discussing the Secure Act 2.0 and its implications to you. And also, we're going to talk about some estate and gift tax planning and also year-end tax planning. I'm joined by my colleagues, Emilee Snader, manager and CPA, and Doug McCabe, partner, CPA, and licensed attorney. So a few housekeeping items. If you could, please post your questions utilizing the Q&A feature at the bottom of your screen. We're going to hold off on all questions until the end of the presentation. Also, this webinar is being recorded and will be posted to our website. So let's get started. Here is our challenge. The Secure Act 2.0, setting every community up for retirement enhancement, is the most significant piece of legislation since the original Secure Act, which was passed in the end of 2019. With a total of over 100 provisions, mostly around retirement plans, we need to first get our arms around the key changes and assess their implications for you. The good news is that there are a lot of numerous benefits to investors as far as having more time to save, ways to save, and then having better access to the money. However, the challenge is just simply understanding the breadth and depth and the timing of all these changes, because they span all the way from 2023 all the way out to 2028. But before we get started, it's important that I once again express that I'm a financial advisor and do not provide tax advice. Everybody's tax situation is different, so we recommend that you consult a qualified tax advisor like Emilee and Doug to discuss your specific tax situation. So as I said, the Secure Act is giving you more time to save in retirement, and it gives you great opportunities to reduce taxes. So what does that mean with more time to save? There are new rules regarding required minimum distributions. So required minimum distributions are required by the IRS that you take out a certain amount every year. And it used to be age 70 and a half that you had to start taking these distributions out from an IRA, a 401k, any kind of qualified plan. Now the Secure Act has increased the age that you have to start taking these forced distributions, which allows you to delay taking these distributions. So you defer the taxes and you allow your account to grow a little longer. You can see here on this table, based on date of birth or year of birth, what age group you would fall into and when you would need to start taking your required minimum distribution. However, if you've already reached 72 since 2022, you probably already started taking your required minimum distributions, you must continue on taking those distributions. Also, it's worth noting that the penalty for missed distributions have actually been reduced. In the past, it was 50% of the missed distribution amount was the tax penalty. So if you had missed a required minimum distribution of $5,000, you would have had to pay $2,500 in penalty. However, that's been scaled back to 25% with a 3-year look back, and then further reduced if you correct it in a timely fashion. It's also worth noting that Roth 401ks, 403bs, and 457s now have eliminated the RMD requirement for Roth 401ks. So in the past, a Roth 401k was treated differently than a Roth IRA with regards to the RMD provision. Roth IRAs have never had the RMD provision, but a Roth 401k did. In fact, it was quite a planning hoop we would have to jump through to make sure that our clients were ready for retirement with a Roth 401k, rolling it out ahead of retirement to make sure you had access to it with the 5-year look back. 5-year clock, but you don't have that anymore, which is great news for those who like to save in the Roth. Previously, you could only contribute to an IRA or Roth IRA until you were 70 and a half, even if you were continuing to work. And then you would be forced to start taking those required minimum distributions. Well, The new legislation gives those who are continue to work with earned income to continue to save past 70 and a half. So you'll have a larger nest egg in retirement. So enhanced catch-up contributions. I want to say first what a catch-up contribution is. So a catch-up contribution is that extra contribution you as an employee or employer can put into your qualified plan after the age of 50, so 50 and older. So it gives you a better chance of building up that nest egg. Well, now, starting in 2024, those catch-ups will be adjusted for inflation. Second, it's important to note if you make over $145,000, it's mandatory that that deposit will go into a Roth 401k account. That was supposed to start in 2026. The IRS has granted a 2-year delay to give those plans and plan administrators and sponsors chance to catch up with the legislation and prepare their plan document to accept the Roth. Next, starting in 2025, a special enhanced contribution has been created for a very narrow age group, 60 to 63. I don't know why Congress chose 60 to 63, but right now that's how they have laid it out. So those who are 60 to 63 can make a greater contribution of $10,000 or 150% of a regular catch-up contribution amount. Same with the simple. The simple has an enhanced contribution of $5,000 or 150% of the catch-up contribution amount. And here is the breakdown. Here's an easy table to see. Of course, no changes up to age 49. The 50 to 59, the standard catch-up, $7,500 in a 401k and 403b for this year. 60 to 63, that enhanced catch-up applies, and then 64 and older, you're back to the regular catch-up provision. So aside from time to save, more time to save, the Secure Act gives you more ways to save in retirement. And a lot of this legislation you're going to see revolves around the Roth and propping up that Roth. And yes, Roths are great. They're Roth IRA, Roth 401k. What that means is you're paying the taxes up front, letting the money grow tax deferred, and it comes out tax-free in retirement under a qualified situation. But yes, Congress wants to help people save, wants to help us Americans save, but they also want to get their tax revenue up front. It's easier for them to plan their budget. So effective 2023, employers can make a matching after tax contribution to Roth. So if you participate in a 401k or offer a 401k as a business owner, you may offer that Roth match option. You don't have to, though. It's up to the employer if whether or not they want to offer this opportunity. Again, just going back to the elimination of RMDs for Roth accounts effective 2024, and also catch-ups for those higher income earners of 145,000 or more will have to defer into a Roth 401k for their catch-up contribution starting in 2026. So starting in 2025, to encourage and increase retirement savings, your employer is required to auto-enroll you in the 401k or 403b plan. Auto-enrollment's always been around. It's been around for, well, not always. It's been around for a while. It's now going to be required starting in 2025. So in year one, your employer will determine how much of your salary they can allow you to put aside for savings, and it will be between 3 and 10%. You'll be automatically enrolled. And then after the second year and later, it'll go from 3% to 15%, anywhere between 3 and 15%. In addition, the number will auto escalate each year by 1% annually. So this is really beneficial to those coming out and new to the workforce, because they'll be auto enrolled in their 401k and start saving early on. Studies have shown that auto enrollment is increasing 401k balances. So Congress really wants to keep that good work going. It also, speaking of year end, might be a good time for you as a participant in a plan to consider auto escalating your deferral starting in January. Usually most plans allow the changes of deferrals in January. So it's a good consideration to take a look at your plan and make sure you're saving enough. Next, we have some good news for part-time workers. A lot of people have to split their time between the office and home. whether they're taking care of an aging parent or a child. And this new legislation allows for part-time workers who work 500 hours for 3 consecutive years or 1,000 hours throughout the year to participate in the 401k plan. Heads up, if you are a part-time employee, check with your employer about when your 500 hours start and end. It's not always as simple as a calendar year. Like I said, continuing on with that theme, the Roth. For 2023, the Secure Act adds 2 new Roth contribution options to the simple and to the SEP IRA. Although I will say the caveat to that is that our custodians, and I know that many custodians have not been set up for this yet. So even though it's effective in 2023, it hasn't been able to be executed this year. Effective in 2023, you can also offer your household employees like a nanny or a housekeeper a SEP IRA plan. It's a nice benefit depending on your financial situation, and you might want to check with your tax advisor to see if there's any tax benefit for you. So simple and SEP plans for Roth also apply create a way for employees savings for 50 employees or less. So smaller businesses, simples might make the most sense. So again, continuing on with the theme for more ways to save, Congress has allowed employers to start putting away money into your 401k for you to defer into an emergency savings account. People don't save enough, especially starting out for an emergency rainy day fund, and this allows you to defer it out of your check into an emergency savings account. However, it's worth noting that highly compensated individuals are not eligible to participate in this. And then also it does cap the withdrawals to $1,000 per year, and it has to be a qualified emergency. But that definition seems to be broad and all-encompassing. So as we all know, America is in a student loan debt crisis. There is a new student loan repayment match where employers can help employees who are paying off student loans. An employer can make a matching contribution on behalf of the employee in a 401k, 403b, 457b, or simple IRA with respect to qualified student loan repayments. This is effective in 2024. In addition, younger earners can start contributing to an IRA with an expanded definition of earned income. In the past, earned income was pretty limited as far as what you were able to contribute to an IRA or Roth, but now they've expanded that income to include stipends and post-tuition fellowship payments so that the young graduate student can get a leg up on saving for retirement. So now we're going to talk about access to the money and how Congress has changed some of the rules to allow more access, penalty-free access to the accounts. So qualified charitable distributions, you might be familiar with those. It's actually a financial planning tool we use pretty frequently with our clients. If you are philanthropic and you really love to give, it's a good way for you to meet your required minimum distribution while also keeping your tax bill a little lower. So the way qualified charitable distributions work is that you, with your IRA, you have a required minimum distribution, you write a check or the custodian cuts a check directly to a qualified charity. They get the full amount and you don't pay taxes on it, and you still meet your required minimum distribution. Now, effective in 2024, the qualified charitable distribution is $100,000, will be indexed for inflation. That's the most you can do in 1 year. Also, the qualified charitable distribution is a direct transfer, and it's important that you note that it has to be a qualified charity under the IRS rules. So a lot of private foundations do not qualify. Again, check with your tax advisor if your charity would qualify. So there's a couple of changes to 529 plans. Before, 529s were kind of limited on how you could access the money. Typically, it had to be used for school qualified education expenses. Now, this rule will allow student loans using leftover 529 plan money to pay $10,000 of student loans, qualified student loans. In addition, 529 plans can now be used if you put money away, you think your child's going to go to college, they choose not to go to college because college is not for everyone. Now you can use this 529 money for apprenticeship programs they have to be registered with the Department of Labor. And just a reminder, the Tax Cuts and Jobs Act did pass or broaden the 529 usage to apply to private K through 12 education as well. In addition, 529 plan funds can now be rolled over directly to a Roth IRA for the beneficiary. So let's just say you have some money left over in that 529 plan. If you were lucky enough to have enough saved, or maybe your child got a scholarship, parents can now take that extra money and roll it over to a Roth IRA in the name. It has to be in the beneficiary's name, in your child's name. Now, there are a few rules to this, okay? So the beneficiary must have earned income, and you can only do a max of $35,000 for a lifetime, but it has to be under the annual limit. So you have to still stick to that $6,500 per year that you can roll into a Roth. That's the only contribution they could make into that Roth IRA or any Roth IRA for that year. In addition, it has to be have been established for 15 years, and any contributions made in the last 5 years cannot roll over to the Roth. The good news about this is rather than trying to find another beneficiary to name for the 529 plan, you can actually get your child, give them a leg up on saving for retirement by rolling and starting the Roth IRA for them. So there are several ways to take penalty-free withdrawals now, and one is to fund long-term care insurance. Paying for long-term care is very expensive. Long-term care insurance is also very expensive, but long-term care itself can cost more than $100,000 a year and can be catastrophic for a family. So the Congress recognizes this, and they want you to be able to pay for your long-term care. Now, it has to be $2,500 annually is the max, and it has to be to a high quality long-term care insurance policy. We need clarity on that. We haven't been given clarity on what qualifies as a high quality long-term care policy. So now that we've talked about saving, let's talk about taking that money out and how that works in estate planning as well, as far as who inherits your IRA and how they can take those funds. Unfortunately, the news isn't good here. Our fourth key point is that your kids still can inherit your IRA, but the big rule change in 2019, the death of the stretch, still applies, and there has been more guidance given on it, but it does affect how your child will inherit, or children will inherit, your IRA or 401k. With certain exceptions, which we'll see in a moment, most Roth IRAs, and 401ks have to liquidate within 10 years for a non-spouse beneficiary. Previously, IRA owners were encouraged to stretch those payments over their life expectancy of the beneficiary, which of course, kept taxes low, and it caused that account to stretch and last longer, right? Well, now they have to liquidate it within 10 years. And this could have major repercussions for the beneficiary. When they withdraw the money, they'll have to report it as income and pay the taxes. And if they have young kids applying for college, it'll increase their income for the FAFSA application. And also, because their income is increased, they may not qualify for certain tax credits. Clarification to this rule has been also published pertaining to whether the original owner had begun taking RMDs or had not begun taking RMDs. More planning is needed more than ever with this sort of rule around IRAs, inherited qualified money, and it's important that you plan. As I said before, there are some exceptions to the new 10-year rule. They include surviving spouses, disabled and chronically ill beneficiaries, those who are not more than 10 years than the decedent, and also minor children. Their 10-year will start at the age of majority, and that varies by state. So for these beneficiaries, they have the option to stretch it over their life, except for the minor child, which will have to follow the 10-year rule once they reach age of majority. But they will also, but this only applies to those who inherited an IRA prior to 2020. So 2020 and later, the new 10-year rule applies. Here is some interesting news. The surviving spouses can now adopt their deceased spouse's RMD schedule. And you're wondering, why would I want to do that? Well, if your spouse was younger than you and they passed, it is specifically beneficial to the surviving spouse because they can use the smaller life expectancy table. So they'll be taking less each year and stretch it out longer over their life. Or if the decedent hadn't started taking RMDs, they can defer those RMDs until the decedent would have reached the age of RMD age. That can be particularly beneficial and good planning tool. So the real lesson here is that the death of the stretch particularly is that tax planning and estate planning are really important more than ever. If you don't work with a financial advisor or a tax advisor, now's the time to really get in there and start looking at your plan. There are tools in the toolbox you can use to help your plan or set you up for success, and Roth conversions, develop a distribution plan from different types of accounts, manage your tax bracket, review your beneficiaries and trusts. That's always important, and create an estate plan that works for everyone, not just for you and your heirs. So with that said, I'd like to introduce Doug McCabe. He's a partner, CPA, and a licensed attorney, and he's going to talk about estate and gift tax issues.
Hey, good afternoon. This is Doug McCabe. As Gigi said, I'm a tax attorney here at PKS and Company. Do a lot of tax work. I also do a lot in the estates and trust and gift area, and a lot of estate planning as well as the taxation of what happens after the person dies, because there's various taxes that are levied and tax returns that are required when a person has passed away. So we're going to talk a little bit here about the federal estate tax. And the federal estate tax is essentially a tax that is levied on a decedent when they die, if their estate is over certain thresholds. And their taxable estate is different than the probate estate and different than other types of uses of the word estate. But the taxable estate is essentially everything that the person owned. It could be in trust, it could be IRAs, it could be other retirement plans, it could be assets that they have in their sole name. It could even be life insurance that they own. All of that is added together. And if the estate is over certain thresholds, then an estate tax return is required. And at the federal level, the amount over those thresholds would be taxed at 40%. Now, way back in the 80s, the rules came out that an unlimited amount can be either passed along at death or gifted to a spouse during life, and there's no tax between spouses. So generally, we see that this this estate tax kicks in only on wealthy decedents, and when the second spouse dies, the surviving spouse dies, and the assets are passed along to their children. That's generally when you see this thing kick in. And currently, we have a very high federal estate tax exemption, and that's at $12.92 million. Call it $13 million for sake of argument. And that is what their estate tax exemption is now. So as long as you're underneath that exemption, then there is no estate tax levied. Now, that amount can be either gifted during the person's lifetime or passed as part of their inheritance when they pass away, or a combination thereof. So they can use some of this gifting while they're alive to somebody other than their spouse, or they can pass it along upon their death, or a combination of both. And I said, we are at $13 million every year that gets adjusted for inflation, so it goes up. But unless Congress passes and we get a new law before January 1st, 2026, that $13 million exemption will revert back to the threshold amounts of 2017 adjusted for inflation. We project that to be about $7 million. So as you can see, the estate tax exemption for a decedent will significantly decrease if we don't get a new tax law somewhere between now and 2026. Now, anybody who has gifted, any taxpayer who has utilized the new higher amounts in 2018 through 2025, used the higher amounts, those gifts will be exempt from taxation if this law actually does sunset the way that it's scheduled to now, absent additional, it's an additional law being passed. Hopefully we get a new tax law that will extend this somewhere between now and the end of the 2025. We don't know that. And if we don't get a new tax law, this law is going to sunset, and the old rules that were put into place from 2017, and previous, will kick back in, adjusted for inflation. So, as I said, if it's going to revert from $13 million down to $7 million unless we get a new tax law put in. Now, again, if somebody has utilized some of these gifting and has given away $10 million, let's say, that gift will be exempt when this law sunsets and we revert back. So at least we have that to work with. So it might be a good time for anybody who is in that situation to make some gifts between now and the end of 2025. Moreover, Maryland has a $5 million estate tax exemption, and that isn't scheduled to go anywhere. And it's also, there's no plan to adjust it for inflation either. That's where we are. Many states do not have a estate tax. Maryland's one of them that does. And therefore, somebody might look to be a Florida resident or some other state if can do that, and therefore you'd escape the Maryland estate tax. The next thing I wanted to talk about is the probate process. For those of you who have ever inherited assets or ever have had to serve as a personal representative or have done both, are probably familiar with the probate process. But essentially, it's a court-observed process to prove the validity of a will and administer the estate and take the assets from the decedent's name and ultimately pay off the creditors of the decedent, and then ultimately distribute those assets in accordance with the decedent's will, or if the decedent didn't have a will, in accordance with state law. So that's the process. The personal representative will be charged with having to file certain documents. You have to advertise in the paper, that the newspaper, local newspaper, that the decedent has passed away, and that the creditors have 6 months in order to stake their claim against the estate if there are creditors that the decedent owed. And then ultimately, the estate will be passed along to the heirs as named in the decedent's will, or if they die without will, state law. The process has to take at least 6 months in the state of Maryland, because creditors have 6 months to come forward to stake their claim if the decedent owed them money, and to prove that, yes, the decedent did owe them money, and therefore need to get paid out of the funds of the estate. The average amount of time that it takes for an estate to get probated and ultimately closed and the assets to go to the heirs is 12 months, a year. So even though it's not a real difficult process in the state of Maryland, it's a lengthy process in the state of Maryland, or any state, basically. It's a lengthy process for somebody to die, and then for all of their assets to go to their heirs as named in the will. And it takes up, generally takes an average of a year, a minimum in Maryland of 6 months. So you might want to avoid probate. And there are various ways to avoid this process so that the assets get distributed out to the heirs very quickly. One would be transfer or payable on death. You see this often with brokerage accounts, with stocks and bonds, or even cash accounts at the bank. You name somebody as a designated person to receive those funds upon the owner's death. Those people have no ownership of it whatsoever while the person is still alive, but upon their death, the person would just submit a death certificate to the investment company or to the bank, and those assets would go to whoever is named as the transfer on death person or designate. Even I want to make this point. Even if the will says that my account at Bank of America is supposed to go to Salad, but there's a payable on death or a transfer death designation on that account at Bank of America that says it goes to Jack. The transfer or payable on death designation supersedes the will. Jack would get the money in that hypothetical, just to let you know how that works. So the payable on death, transfer on death actually supersedes what is in the will. The same thing happens with beneficiary designations. Beneficiary designations, as you see often on retirement accounts, will supersede the will. So it's a much more streamlined process to get the assets to the heirs by using a transfer payable on death on a brokerage account or on a bank account. Assets held jointly with rights of survivorship, those go automatically to the surviving joint tenant upon the tenant's death, before the deceased tenant's death. Again, those would pass outside of the will, doesn't have to go through probate. Joint tenants with rights of survivorship is a designation used with a non-spouse. The same criteria works as far as the surviving spouse getting, or surviving joint tenant getting all of the funds in that account with tenants by the entireties. But tenants by the entireties is reserved for spouses. So joint tenants with right of survivorship, non-spouses, tenants by the entireties is a joint tenancy between two spouses, but they work the same. And that is that the assets are automatically taken from the deceased joint tenant, and it goes to the surviving joint tenants or tenant. The problem with this could be the fact that that joint tenant has rights to that money during the person's life. You put somebody on there as a joint tenant, now they have rights to that money while they're alive, where the transfer on death does not have that. There's no access to that money by that designated person until they pass away. Trust, like a revocable trust, is another way of avoiding probate. A revocable trust is amendable, it's revocable, you can change it, you can do whatever while the person is still alive. The person who makes the trust, they're called the grantor, the trustor. And that person puts assets into a trust, and they can do whatever they want with that money while they're still alive in that trust. But upon their death, it becomes irrevocable, and then those assets go to whoever is designated in that trust document to receive those funds. Now, the trust document is only good for the assets that are actually titled in the trust. Assets that were not titled into the trust, the trust document has absolutely no authority over those assets. And then the last one is a life estate, and that is, you see this a lot of times with real estate, where the person that creates the life estate, the life tenant, they create a situation where they have lifetime rights to that piece of real estate. Generally, you see it in real estate. They can live there. They can oftentimes sell it. It depends. There's with powers and without powers. Some with powers you're allowed to sell it. Without powers, it means that they cannot sell it. but they have the rights to use that asset, that real estate, while they're alive. And then upon their death, right in the deed, it says it goes to remainderment, people named in the that receive that asset automatically upon the life tenant's death. And that's another way to avoid probate on real estate. So that's what I have there. I think that's all I have for today, right, Gigi? Another slide?
Yep.
More slide? Okay. So we're
Thank
on to
you.
Emilee.
Yep, on to Emilee.
Hi, everyone. I'm Emilee Snader. I'm a CPA and a tax manager in the West Ocean City office at PKS. Today, we're going to go over a few just kind of general tax planning strategies. So if you're eligible to, contributions to retirement accounts, HSA accounts, and 529 plans are a great way to lower taxable income. Not only that, but they provide a means to save and grow your income tax-free. They do require an additional cash outlay now, but you will end up keeping more of your own money this way. I suggest contributing as much as possible to these types of accounts and plans. Of course, there are rules for eligibility and limitations on the amount you may contribute. I'm not really going to go into much detail here about the specific limits, but there are general limits, as you can see. The retirement and HSA account contributions directly reduce federal taxable income. The 529 plan for college savings offers a state tax deduction in many cases. Not all states have a 529 plan tax deduction, but Maryland, Delaware, and Virginia do. A Roth conversion, where you can convert all or a portion of a traditional IRA to a Roth IRA, may be something you should consider. This is another strategy that involves an additional outlay of cash now, but it can be a very effective planning tool. It's best for those who are in a lower tax bracket now that expect to be in a higher tax bracket later in retirement. You can pay tax on the deferred income now at a lower rate and allow it to grow tax-free until retirement. This can help lower your tax bracket later, since when the funds are distributed, they will not increase taxable income. This may lower taxability of Social Security benefits or even reduce the net investment income tax as well. Consider harvesting gains and losses. In other words, if you are considering selling securities or stocks, you can take advantage of whether they will be sold at a gain or loss. You may want to sell at a loss if you have a large capital gain from the sale of real estate or a business activity. But remember, only $3,000 of net capital losses can be deducted against ordinary income per year. Any net losses beyond the $3,000 will carry over to future years. You may want to sell at a gain if you have a capital loss from the sale of real estate or business activity, or you have capital loss carryovers from prior years. Are you planning to sell real estate and considering investing in more rental real estate? This is very common right now with the way the market has been. If so, you should consider doing a like-kind exchange. It's also known as the 1031 exchange, to defer the capital gain on the sale. The gain won't be recognized as taxable income until you sell the exchanged property later. There are strict rules and time limits to invest in the new property, however. You must identify the new property within 45 days of the sale, and the new property must be purchased or exchanged within 180 days. There's also a chance you will have to recognize capital gain in the year of the sale if, for example, a mortgage is paid off, you have cash received on the exchange, or if there's personal property received on the exchange. Most of the time, this is either furniture or a trailer. Since the Tax Cuts and Jobs Act took effect in 2018, we have had these much higher standard deductions than in the past. For 2023, the standard deduction is $13,850 for single filers, $27,700 for joint filers, and $20,800 for heads of household. With standard deductions as high, it's become more important to have a strategy for whether you're going to itemize or take the standard deduction. It might even be best for you to alternate years of taking standard and itemized deductions. You can plan to maximize the itemized deductions by bunching them in alternating years. If you have a medical procedure or expense that you have control over the timing of, you may want to expedite them before year end or push them off until January of the next year if you're trying to wait until the next year to itemize. But keep in mind that you can only deduct medical expenses over and above the 7.5% of AGI, or your adjusted gross income. This means many medical expenses go unused as a deduction because there aren't enough to get over that threshold, or there are enough to get over the threshold, but there still aren't enough other itemized deductions for them to be more than the standard deduction. You could also group charitable contributions. This is a popular one. Contribute 2 years worth of contributions every other year. And this tends to work really well, especially for those that contribute a regular amount to a certain charity. A lot of times we see this with people donating to their church because it's like a regular tithe that they're doing. If the standard deduction will be higher than itemized deductions, you can divert otherwise lost itemized deductions to be deductible in a different way on a different place on the tax return. Lost medical expense deductions might be eligible to be deducted as self-employed health insurance if you're self-employed, or you could run it through a health savings account if you have a high deductible health plan. And both of those could be good strategies to use even if you are itemizing, since there may not be enough medical expenses to reach that 7.5% of AGI threshold. Real estate taxes and mortgage interest may be partially deductible as home office expense if you're self-employed and you have a home office. Charitable contributions may reduce otherwise taxable required minimum distributions of IRAs or other retirement accounts by doing a qualified charitable distribution like Gigi spoke about earlier. But remember, those are only for those over 70.5. And state income tax may be paid by a pass-through entity or a PTE instead. Also, with the Tax Cuts and Jobs Act, the state and local income tax, or the SALT tax itemized deduction, was capped at $10,000. This has been in the news so much. And really what it means for a lot of people, especially in the high income tax states, is that they've lost a huge deduction that they can no longer take. So many states have created a workaround for pass-through entities, PTE, owners to still deduct state taxes created by the S Corp or partnership. You can elect to have the PTE pay the state tax on behalf of owners instead of the owner paying taxes at the individual level, where the deduction will most likely be capped at $10,000 and lost. Then the state tax can be deducted on the federal return of the S Corp or partnership and still deducted. You might even want to consider this for if you have a 1040 real estate rental or otherwise a real estate rental that's just reported on your 1040, your individual return. You might want to consider becoming a partnership so that you can take advantage of this PTE state tax deduction. Of course, that's only going to work if you are a partner, so there has to be more than one. So for example, if it's husband and wife own the real estate property together, you could become a partnership. Though you really should consider if it makes sense to do this in your situation. A separate return is going to have to be filed, and there's some other considerations to keep in mind. You could also consider moving a profitable Schedule C business, a sole proprietorship that is recorded on your 1040 to an S corporation to take advantage of the PTE state tax deduction and to save on self-employment tax. Though there are even more considerations to think about in doing this. Again, a separate tax return would need to be filed. Payroll would have to get set up for the owner's compensation, and it might even create basis issues. So you really want to talk to your tax advisor before doing this, but it would get you to be able to deduct that PTE state tax deduction. And then last but not least, make sure your tax withholdings and estimated tax payments are up to date and as accurate as possible. Consider changes to tax withholdings of wages, IRAs, pensions, annuities, and Social Security benefits instead of doing estimated tax payments. It's usually more efficient this way, and then there isn't so much planning involved year to year. You also want to avoid underpayment of estimated tax penalties, underpayment of estimated taxes to avoid the penalties. You will be penalized if tax payments for the year are the lesser of 90% of the tax for the current year, or 100% of the tax from prior year, or this will be 110% of prior year AGI if your prior AGI was over 150,000 for married filing joint taxpayers and over 75,000 for single taxpayers. There is no penalty if the tax owed is less than $1,000. But also keep in mind, payments are to be made in 4 equal quarterly installments to avoid the penalty. Even if the total payments for the year are made, you may still be charged a penalty if a quarter of the payments weren't made in each quarter. So the timing is important. Should also avoid over withholding and paying taxes. Just consider the time value of money. Instead of paying too much up front, you could save it or invest it and collect interest until the tax is actually due. So all of these are just a few tax planning strategies, but please remember, these are not one-size-fits-all strategies. There might be reasons why these strategies won't be the best and most beneficial thing for you to do. So it's always best to reach out to your advisor for planning for your unique situation. And
Thanks, Emilee.
Open up questions.
Yeah, we do have a question here. Doug, I think this will be for you. Does the state of Delaware have an estate tax? No. No, Delaware does not have an estate tax. So that kind of wraps it up for all of us. Thank you for joining us today. I think at the end of the day, we just need to think about, we're coming out on year end. As Emilee mentioned, there are some tax planning strategies. Doug mentioned some estate tax planning strategies. And then, make sure your contributions are being made before the year end. If you're contributing, you want to max out your 401k. And then also tax loss harvesting. That's another popular item to consider, working with your advisor to get some gains and loss, or get some losses on the books if you want to decrease your taxable income. So thank you for joining us. And again, as I said, this will be posted to our website if you want to share it or replay it. Thank you.